smaller companies direct plan in November 2017. Since then, it has given negative return. Should I stay invested in this fund or switch to some other small cap fund? My investment horizon is more than 10 years. Franklin equity funds have also come under pressure, and I don't know how long will it linger, because what happened to their 6 of their debt fund, a lot of investors got nervous and they started pulling out money, and that has caused extra pressure on this fund. Otherwise, I find this fund good enough, and given that next 7 years you have to remain invested, it should work out well. But just to be cautious, pull out your money if this is the only small cap fund you have, and move to some other small cap fund. Harish Naidu is asking that given the market volatility and downside, is it better to avoid IPOs and buy after listing is made to prevent loss? I don't think of investing in IPO as any mainstream equity investment strategy. IPO should be looked upon for individual investors. It should be looked upon as one-off small investment that you make, and look at it as a fund allocation mostly. Because in IPO you don't even get allotment in a meaningful way unless you are a big investor. So because for individual investor up to 2 lakh rupee investment, and the ratio, if it's a good IPO, then the times oversubscribed, the likelihood or probability of getting allotment is very low. So if you like a company, if IPO creates an opportunity whereby you get to know a company and you like it and you think you should be buying it, so there is the fear of missing out. You should not look at it, because there is a possibility that in IPO you will get, you want to invest in a company which is coming up with an IPO. You'll get a small allotment, and if you like that company, you will get some opportunity. There is a possibility that the price doubles soon after listing, and that can itself become a barrier. But so from that standpoint, IPO has of limited appeal, and then once they become normal company which is listed, actively traded, you will get some opportunity, and accordingly, think of it as a long-term investment. You should have few stocks which has to be held for many years, and you should evaluate it as any other company. Rajiv Kamath is asking that I want to invest a lump sum amount of 12 to 18 months, taking some amount of risk. I want to choose between a corporate fixed deposit and a corporate bond fund. Which one is better option? Corporate fixed deposits are also unsecured, and corporate bond fund will definitely be a better choice, even if you get slightly lower returns, simply because it will spread your risk. If you put your money in a corporate fixed deposit and the money gets stuck, all your money will be stuck. If you invest in a bond fund, and if it faces a calamity and it loses money on 1 or 2 bond that it has invested, a small part of your money will be stuck. So looking at the downside, I think diversification is better. And of course, it will translate into some compromise on return in terms of the fund will have some allocation to AAA, some allocation to AA, and some government securities to ensure liquidity and things like that, or to ensure continuous liquidity. But I would say that fixed income investor investing for 12 to 18 months should go for a corporate bond fund, simply for sake of diversification and reducing the risk. Dinesh is asking that Value Research classifies focused funds under multi-cap category. Can I use focused fund to form the core of my portfolio? Yes, it can well be. Focused funds can invest up to 30 stocks, and most funds are generally invested in 20 stocks or more, or about that much. And they can well be a mainstream category. It can well form the core of your portfolio. Saswati is asking that I want to invest 40,000 per month for next 10 years for my long-term goals. How Value Research Stock Advisor service can be utilized for my purpose? I have already invested in mutual fund for last 5 years. Please suggest. Subscribe to Value Research on Stock Advisor. 40,000 rupee. Look no further than best buys there. Though we have 40 recommendations, and 5, 7, 10 recommendations can also come in the next 6 months as and when we get an opportunity. We are sitting or sleeping on a pipeline of our recommendations, which is on our analyst watch list, nearly 12, 13 stocks, but we haven't got an opportunity to recommend that purely on valuation front. We have concerns about that. We don't think it is the opportune time to recommend that. Value Research Stock Advisor, the best buys list, the 15 stocks. Today it is also being revised. two stocks are moving out of it into main other, will not be best buys, and two stocks are getting added to the best buys. So take a look at the best buys and invest. And today it is possible to, invest small amounts of money in those 10, 12 stocks. Of those 15 stocks, maybe choose 10, 12 and start doing your SIP of 40,000 rupees in those stocks. And because you have already built your portfolio in mutual fund, don't fiddle with that. Let it remain there. Start building, and gradually you will learn that, which one to buy today, which one to buy next week, which one to buy next week. Maybe, just learn in the process of, building your portfolio. And I hope that, this experience turns out to be rewarding. Dheeraj Thakkar is asking that I have two questions. The first question is when any IPO launches, should I subscribe or not? The second question is, should I hold or sell after getting listing gain? IPO should be a very small part of your whole investment equity allocation, simply because you have absolutely no control on how much, you have no control on when IPOs will come, whether they will be good IPOs, and how much allotment will you get, because getting allotment in an IPO is a lottery. The better the company, the higher the number of times it will oversubscribe, and it lowers the probability of allotment to you. And then, a company has to be held for many years, company stock. So you will get some opportunity. Use it as also, let me tell you that Value Research Online comes up with, a very interesting analysis of each and every good IPO. Take a look at that. We give a very specific score to each and every company that is coming out with the IPO, and we ask 30 questions, and you can look at it yourself. It will help you understand. Use it as a learning opportunity. Take it as a fun allocation. In an IPO, you cannot build a meaningful position. If you have a 50 lakh rupees portfolio, and if you want to put 10% of your money in an IPO, it's not possible. You will not get the allotment. So start using this opportunity to learn, keep track, and maybe, have some fun. Many of the good IPOs will double on allotment, on listing, but the amount that will be allotted to you will be so meaningless that I don't know whether you'll be happy. You'll be happy that you got allotted, and you'll be unhappy that you got allotted so less. So I would say that it is something on the side. Use it to learn, use it to have fun, but don't base your investment strategy based on IPOs. Dhirendra Kumar Gaur is asking that what is my opinion on FMPs? I have invested in FMPs like Aditya Birla Sun Life Resurgent Fund Series 7, HDFC HOF 1, ICICI Value Fund Series 19. What is in store for me as all these schemes are performing very badly? Oh, these are not FMPs. These are closed-end equity funds, and they were bad. Most investors should not have been investing in closed-end funds anyway. The biggest choice that you have, we invest in mutual funds based on its track record. In a closed-end fund, you have no track record to invest, and then your money gets locked. And it was entirely because of the pricing and the incentive system which prevailed around closed-end fund, because of which closed-end funds were sold. And most investors have been disappointed. And you also don't have a way out, because it is doing poorly, and you can't do anything about it. You have to wait till it is redemption. So I'm sorry. And it is disappointing. You have to wait till the redemption, get your money back, and make a rule that never invest in a closed-end fund in future. Manoj Arkadi is asking that I subscribed to Value Research Stock Advisor recently. My question is, best strategy to invest in these stocks? Do monthly SIP, invest on every dip of 10%, and 3, for how many years should I spread my investment corpus of 25 lakh rupees to invest in these stocks? I'll take the easy question, or something about which I have a framework first, which is point number 3. How much time should how much time you should be spreading? It depends on person to person. If it has taken you 1 year to earn this 25 lakh rupees, then spread it over the next 6 months. If it has taken 5 years, then spread it over the next 2.5 years. Reason being, don't spread it beyond 3 years, because that doesn't help. And if it has taken 5 years, 10 years, then definitely spread it, which means that this money is very important. It depends on the scale of money and how important it is. It is a relative thing. 25 lakh rupees can mean different things for different people. So spread it over, generally speaking, spread it in half the time it has taken you to earn, or maximum of 3 years if it has taken a long time for you to save or earn this money. Should you do SIP? Yes, do SIP, but also do the second part, buying on dips. This is our instinct. So I would say that do your SIP to the tune of 75%, and remaining money, 25% of the money that you plan to invest, wait for the dips. If you get lucky with the dips, it's fine. If you don't get lucky with the dips, after you've exhausted your money, then that money also can get invested. But 75% of your money will get methodically invested by way of regular monthly investment into the best buy stocks or whatever stock you have chosen from the stock advisor recommendations. Nirjar Yadav is asking that almost 60% of my equity allocation is towards giant and large cap combined, and mid cap is around 15%. Still, the fund style matrix on the analysis tab of my investment page shows overall allocation as medium capitalization. Why? Because you have 25% in small cap. If 60% is large and giant, 15% is mid cap, remaining is small cap, and almost 50% is mid and small. That is why you are getting slotted in the middle thing. Because the market capitalization of the overall market, 70% accounts for large cap. So I would say that if you have 70% and more, then it will get slotted as large cap. So on a relative basis, your portfolio is tilted more towards mid cap and small cap as compared to the market, because this is also a relative score, relative allocation to the different segment of the market. That is why. Vinod Miryala is asking that can we apply for UTIMC and Mazagon doc shipbuilders IPO for long-term gains? These issues are closed now, but nevertheless, I have answered this question that IPO should be a very insignificant part of your total equity allocation, because of there's a lottery element. You can't, if you invest for individual investors, you have absolutely no control on the availability of these IPOs and how much allotment you will get. So think of companies for long term. Use it as a learning opportunity and a fun allocation, a small money, and there is absolutely no risk. If you don't get any allotment, today you invest your money through ASBA. ASBA meaning, there is a billion on the bank, in your bank. If you have 50,000 rupees lying in the bank, you can make an investment in the IPO. If you don't get allotment, the money does not even move out of your bank. It remains there. If you get allotment, only that much amount which is needed for that allotment gets debited from your bank account. So basically the money keeps lying there and you are able to take a chance on the allotment. And if you get many a times, good companies IPO, but be selective. Bad companies, when you get a smell of it, keep away from it. And value research will help you. Value research comes up with very interesting information analysis on each and every interesting IPO. Read that, use it as an opportunity to learn. It will also give you an indication of which IPOs you should avoid. Pavan Kukreja is asking that which fund should a retired person invest in from where he can get regular income as and when required, either by SWP or by redeeming units. Plus the remaining corpus can keep accumulating returns. It depends. For somebody who is looking for less periodic and insignificant supplementary income from his investment, he can well invest in an aggressive hybrid fund. Or somebody can invest in allocation where you can target is 50% equity, 50% debt, which many of the balanced advantage funds can achieve. If you are going to be heavily dependent on this income in a reliable way, then after you have invested your money in senior citizen savings scheme, post office MIP, or LIC's Yojana, after that put money in these equity income fund, equity savings fund. Equity savings funds are nearly a third in equity, 2/3 in fixed income. They are a relatively steadier take, and if you actually put a withdrawal rate of something like 4 to 5% per annum, I think you will still have your capital growing steadily and a part of the gains coming to you. And when investing in funds and deriving periodic income, SWP is the best way. It is the most tax efficient way. It is also convenient way. and you can decide how much money you want every month, and it is like giving a standing instruction to your fund that give me this much money every month on this date. And what you are saying that redeeming units, SWP is nothing but redeeming units every month at a pre-decided date and of pre-decided quantum amount which comes to your account. It is predictable. Prashant Srivastav is asking that what basic things should be seen while applying in IPO. You are buying equity, you are buying the shares of a company. So all the things that you see in a company, which is a growing company, a company which is managed by able people, honest people, people with integrity, a company with potential of growth in future, and which has a good return on equity. And all these questions will be answered in Value Research Online, the IPO analysis, the IPO information analysis which we do. Read those 30 questions. It will take you 10 minutes, and you will form and you will be well informed about these investments. Whether you invest or not is your choice. But I think learning on the way is a nice way of is another benefit. Sharat Vasan is asking that for a new mutual fund investor like me, does the recent guideline on multi-cap funds make a difference? I have traditionally been a stock picker mostly on large cap side. I have written a first page column on this. Go to Value Research Online, look for my first page on what happens to multi-cap. But briefly, I can say that do nothing. The regulations on multi-cap is is quite a constraint on many of the larger sized multi-cap funds. And SEBI is enabling a mechanism whereby there will be a fund category created, so that all the funds who can't comply with this new rule of having a minimum of 25% allocation to small cap and mid cap can migrate there. And there they will have the liberty of investing wherever they want to. And so in that sense, you don't really have to worry about complying with this. Fund companies will worry about it. I think, you don't have to do anything. And read that column, it will get you some perspective. Sanjay is asking that my grandparents are 86 and 84, and they have 35 lakhs rupees with them. Now, which needs to take care of their daily lives, 10 to 12,000 per month, and healthcare of 4,000 rupees. How would you suggest to invest the money they have? Since they require just about 5% of their corpus, they should have, part of this investment in equity, and use the portfolio builder tool as, some time from now, though it's now getting a little embarrassing because I've been telling you for these many weeks, and it has been many months, nearly 8-9 months ever since we announced the launch of premium, and we have not been able to launch it so far. But the days are numbered. We are getting closer to it. We are about to launch. My apologies for this delay, and but we are now days away from launching it. Please bear with it. But getting to your answer, I think the simpler way of achieving this goal will be investing in a equity income fund, equity savings fund, one or two good ones, and mounting a 5% annual, monthly, 5% annual divided into monthly withdrawal plan, and that is it. It will keep it simple, and they will rely on that income. And I hope that there will be a appreciation of his capital, so which it can their income can also potentially go up. Okay, regarding Franklin Templeton's, Sebastian D'Souza is asking that regarding Franklin Templeton's fixed shuttered scheme, would appreciate if a regular column is devoted on the various happenings on liquidation of the schemes, either in Mutual Fund Insight or website. You owe it to your readers who have subscribed to the schemes based on the recommendations and ratings over the years. Absolutely. We not only owe it to you, we are ourselves very curious about it, and we are on top of all the happenings. In fact, there is a story on Value Research Online on the home page all the time, because every few days I get an update and we are updating that story. Even now, if you go to Value Research Online, there is a Franklin Templeton update story on the front page of Value Research Online, and you will see the first, and it is a bullet point update. So you have, there is a complete timeline, everything that has happened to these funds, and I think I will just share with you the latest news. Last week, Franklin Templeton's reported a short while ago that their cash flow into these 6 funds have been to the tune of little over 1,000 crore. and the cash position in the Franklin's ultra short-term bond fund is nearly 40%. The other two funds were 20% or 19% and 19%. Two other funds which were not cash positive and they were not done with the outstanding debt, they are getting closer to that. They're getting close to winding up their loan positions. So you have an update, and we definitely owe it to you, and I'm hopeful. In fact, Franklin Templeton has gone on record to say that the hearing in the court cases is over. The judges are preparing the judgment, and we should be expecting some guidelines on that anytime now. The hearing from all the parties is over. Raghu is asking that could you please share your insight into ESG fund as it is, and is it worthwhile to invest in them? Since I like the concept of this investment, I too like the concept, and it's quite understandable. It also makes a great investment case. ESG is, environmental, socially, and corporate governance compliant or focused, or companies, and this also makes investment sense. But at the same time, don't be guided by this. I mean, in a certain way, Indian markets are quite influenced by this. In fact, it is very much reflective. It is reflecting on the market preferences of the investors, in a sense that if you look at the high dividend yield of the environmentally unfriendly companies like, I would not say totally, but something like ITC, which is you can say socially, it's the largest manufacturer of cigarettes, or you look at the PSUs, the oil companies. Which will be polluting, or so look at the way they are out of favor, despite growing their revenues, despite growing their profits, and despite such huge dividend yields. A growing business, a thriving business, but it is completely out of favor, primarily because a lot of investors now take note of that and keep away or invest more in some other companies, and that has also led to a great polarization of the investment universe. Good companies compliant with those norms are, they look expensive, but they have remained expensive for too long. Rohan Gupta is asking that I'm a salaried person and I have a question regarding extra savings in a month. The money is left after consumption and allocated to defined goals. As this money is variable, we don't have visibility of its future requirement. Where should we invest? It is, generally speaking, the other way around is a better option. Before you start investing, prepare a budget and invest before you start spending. That way, and keep some buffer in terms of, so that you're not deprived of essential consumption that might be the discretionary spending that might be needed, which could be quite ad hoc, or you can anticipate that. But I would say that multi-cap or a diverse portfolio, the money which you are unlikely to need for a couple of years should be invested there, and many years, consider a more aggressive portfolio. Not too many years, 5-7 years, consider a more diverse, a well-diversified portfolio. Sachin Parekh is asking that with large cap funds gaining traction from investors, do you see a crash in near term by overbought position? How to balance in this situation? No, don't make all these assumptions, Sachin. All these overbought, oversold, all these things, because there is something substantially changed. One is that large companies in lean times, big gets bigger. That's one. The other is that the cash flow, the flow into the market in a certain, so indexing has become popular. The largest largest equity fund in this country, suddenly from nowhere, 5 years ago we had absolutely no presence. But today it has become the largest fund, 1 lakh crore Nifty ETF. That's a huge size, 100,000 crore invested in the Nifty. And this is likely to continue. This is likely to continue because Employee Provident Fund Organization has started investing 75,000 tentatively, approximation. I don't have the precise number based on my estimates of what percentage of their asset was there in the fund in the last 2 years. Based on that, my guess is that 75,000 crore of rupees has been invested in by Employee Provident Fund, and they will keep investing every month because the contribution of employees comes to Employee Provident Fund every month, and they keep investing here every month, averaging. And this is the only hope. This is the only equity investment, and this has democratized equity investment because EPF subscriber, all those private sector employees whose PF is deducted, is now a small part of it, a very small part of it, is getting invested here. The headroom for investing more is still there, and it can happen over a period of time. So this is not an overbought position. This is long-term money chasing large cap stocks through index funds. And because more money will keep flowing in, don't bet against the market. So I would say that, small cap has its own promise. Mid-sized companies have its own promise. They can also gain traction. We have Junior Nifty, we have new kind of index funds being launched that can also drive, and once they start doing well, they achieve the threshold scale, they are able to demonstrate their ability to perform, more people will invest in it. So don't bet on that, invest. Make sure that you're investing. If you become sophisticated, if you can't understand anything, invest in an index fund. If you can choose a good fund, invest in them. If you can make a good mix of equity fund, do that. Use our best fund or the premium service as and when it's offered a few weeks from now. Use that. If you can enjoy using choose your own stock, use stock advisor or use your any other resources to build a good equity portfolio for the long term. But invest. All these things will make small difference, and if you're investing regularly, you will not have regret, because you still have to invest in future, and you will go wrong with couple of investment that you have made at a certain point which looks like you have caught the market high. It doesn't matter. Nalini Nikanti is asking that I have invested 10 lakh rupees in Nippon Gold 10 ETF at NAV of 48 rupees 50 paisa. Now it is around 44. Should I add or hold the same? What is the appropriate time frame for gold to reach my purchase value? There is no appropriate time. You have bought this is the problem of chasing market momentum. Gold did very well. It went up by 54% since the start of this year. It went up by 60% if you look at 1 year return, and now it has started correcting. Gold has become volatile. Gold is not a great long-term asset. Maybe last 10-12 years it looks impressive. If you have gone wrong, you were not making an investment, you were chasing a momentum. You have gone wrong, square up your losses, because it can go up before it goes down by another 10-15%. You never know. If we have normalcy in the world and the corporate earnings kicks in, I think gold can fall further. So but definitely I don't have a view, but this is not the way to invest. You should not be chasing based on what has done very well in recent times, and then you have invested a sizable money. You have lost 10% of 10 lakh rupees invested. It will be little over 9 lakh rupees run now based on the current thing. Square up your losses, else you just might have to hold it for a long period or stop looking at this. Nitin Jain is asking that I have invested 10 lakh in HDFC Balanced Advantage Fund, hybrid dynamic asset allocation fund. By their definition, these mutual funds invest in both stocks and bonds. The fund has degraded my asset by over 10%. What should I do? Yes, we are also greatly disappointed by this fund. You should sell. Thank you very much for sending your questions and listening to my answers, and I hope